what happens when trust leaves money. Not gradually, not politely, but quietly, almost imperceptibly at first. I've spent much of my career thinking about that question because it sits at the center of every financial system we've ever built. Money doesn't fail because paper wears out or because numbers stop adding up. It fails when people stop believing that tomorrow will look enough like today for promises to matter. For a long time, I didn't fully appreciate how fragile that belief really was. Like most people trained in economics and law, I thought of money as infrastructure, solid, regulated, reinforced by institutions that had survived wars, depressions, and political change. I assumed that trust was embedded in the system itself, not something that had to be renewed every single day. I learned otherwise the hard way. The first time I saw trust leave money, it didn't look like chaos. It looked like hesitation, a pause that was just a little longer than usual, a question that hadn't been asked before, a request for reassurance that used to be implicit. Those moments are easy to dismiss because they don't feel dramatic, but they're the moments when the system begins to change character. Money at its core is not value, it's a claim on value. And that claim only works if everyone involved agrees to honor it without constantly renegotiating the terms. As long as that agreement holds, money feels invisible. You don't think about whether your bank deposit will be there tomorrow. You don't wonder if a payment will clear. You assume the system will do what it did yesterday. That assumption is the system. I remember sitting in a meeting years ago advising on financial risk when someone asked what seemed like an abstract question at the time. What if counterparties begin to doubt settlement itself? Not market prices, not asset quality, but the basic mechanics of payment and delivery. The room didn't react strongly. The question was noted, acknowledged, and then gently set aside. It felt too theoretical, too remote. But once you've seen it happen, you never forget it. When trust leaves money, the first thing that changes is behavior. People stop acting automatically and start acting conditionally. They want confirmation. They want guarantees. They want margins of safety that didn't seem necessary before. The system, which depends on speed and confidence, begins to slow down. And in slowing down, it reveals just how dependent it was on trust in the first place. I've watched this play out in crises that later filled history books. In 2008, banks didn't stop lending because they suddenly discovered they were undercapitalized. They stopped because they no longer trusted each other's balance sheets. Once that trust was gone, no amount of reassurance could restore normal behavior overnight. Central banks injected liquidity, governments made guarantees, and still the hesitation persisted because trust once questioned doesn't return on command. That's the part most people miss. Trust is not mechanical, it's psychological. It doesn't respond instantly to policy tools. You can create liquidity, but you can't force people to use it if they're unsure of the outcome. Money can exist in abundance and still feel scarce if confidence is absent. I've seen this dynamic in financial war games designed to explore worst case scenarios. On paper, the system always looks resilient. There are backstops, facilities, and coordination mechanisms. But when you introduce doubt into the scenario, everything changes. Markets still exist, but they no longer clear efficiently. Prices are still quoted, but they lose meaning. Transactions still occur, but only with increased friction. What struck me in those exercises was how quickly the conversation shifted from economics to psychology, from models to behavior. Once trust became uncertain, the tools everyone relied on lost precision. Liquidity assumed participation. Participation assumed confidence. And confidence was no longer guaranteed. There's a subtle loneliness in seeing this early. When markets are calm and systems appear to function smoothly, talking about trust feels almost inappropriate, like questioning gravity on a clear day. People look at you as if you're overthinking something that's already been solved. In a sense, you are overthinking it until you're not. False stability makes trust feel permanent. It convinces people that money will always be accepted because it always has been, that institutions will always stand because they always have, that tomorrow will resemble today closely enough to justify long-term promises. Those beliefs are not irrational. They're just incomplete. I often think about how rarely people ask what gives money its power. Not its price, but its acceptance. Why does a digital entry in a ledger carry weight? Why does a piece of paper settle obligations? The answer isn't physics or math. It's collective belief reinforced by habit and authority. That belief is strong, but it's not immutable. When trust begins to erode, it doesn't announce itself loudly. It shows up in small ways. A preference for immediacy over promises. A shift from abstract value to tangible assurance. People stop asking how much something is worth and start asking whether it will still be worth anything tomorrow. That shift is quiet, but it's profound. I've learned that the most dangerous assumption in finance is not that crises won't happen, but that trust will always be there when we need it. Trust is not a resource that can be stockpiled. It's a condition that has to be continuously maintained. And when conditions change politically, economically, or socially, trust can thin faster than most systems are designed to handle. This is why the departure of trust is so destabilizing. It doesn't just affect markets, it affects behavior across the entire system. People become cautious at the same time. Liquidity retreats simultaneously, and what looked like a robust network reveals itself to be a delicate web. I'm not saying this to suggest that trust is about to vanish. That kind of speculation misses the point. The point is understanding what money really is and what it depends on. Because once you understand that money is trust, you begin to see stability differently. You stop taking acceptance for granted. You start noticing the conditions that sustain it. There's a quiet clarity that comes with that realization, not fear, but awareness. You begin to recognize that the system doesn't fail because it's evil or incompetent, but because it's human, built on beliefs that feel solid until they're questioned. As we go deeper into this conversation, what matters isn't predicting when trust will leave money. What matters is understanding how the system behaves when it does and why that behavior feels so surprising to people who assume trust was permanent. Because once you see money for what it really is, you can't unsee it. And that changes how you interpret every calm moment that follows. The moment trust actually leaves money is rarely the moment people expect. It doesn't arrive with a headline announcing its departure. It slips away in the space between transactions, in the pause before a decision, and the quiet recalculation that happens when certainty no longer feels automatic. I remember the first time I saw that gap open in real time and how unsettling it was, precisely because nothing appeared to be wrong on the surface. It happened during a crisis meeting that followed a market disruption most people barely noticed. From the outside, it looked contained. Prices had moved, but not dramatically. Official statements were calm. The language was reassuring. But inside the room, the conversation had already shifted. We weren't talking about markets anymore. We were talking about settlement risk, about whether obligations would be honored exactly as promised, exactly when promised. That distinction matters more than most people realize. Trust leaves money when participants stop assuming performance and start demanding proof. When that happens, the system slows down, not because anyone panics, but because every step requires confirmation. Every confirmation introduces friction, and friction multiplied across millions of transactions becomes systemic stress. I've seen this play out in financial war games designed to test resilience under extreme conditions. At the beginning of those exercises, everything behaves as expected. Institutions respond, liquidity is provided, markets adjust, the system looks flexible, adaptive, but then we introduce a simple change. We question the reliability of one link in the chain, not a collapse, just uncertainty. And the reaction is immediate. Participants begin to protect themselves, margins increase, exposure shrinks, activity declines. What's revealing is that no one has to declare a loss of trust for it to take effect. Behavior changes first. Language follows later. That's why official reassurances often lag reality. By the time confidence is publicly questioned, it has usually been privately eroding for some time. I think back to 2008, not as a historical event, but as a sequence of behavioral shifts. Banks didn't stop lending because they suddenly discovered risk. They stopped because they couldn't be sure who was exposed to what. Transparency vanished. Balance sheets became suspect. Trust, which had allowed trillions of dollars to circulate daily, evaporated almost overnight. The plumbing seized not because it was poorly designed, but because it was built on assumptions that no longer held. Central banks responded with speed and scale. Liquidity was injected, guarantees were extended, facilities were created, and eventually activity resumed. But what's often forgotten is how long it took for trust to return and how conditional that return was. Even after markets stabilized, behavior remained cautious. The system functioned, but it felt different, more brittle, more dependent on intervention. That dependency is one of the lasting consequences of trust leaving money, even temporarily. Once participants experience how quickly confidence can disappear, they adjust, they shorten time horizons, they reduce exposure, they become more sensitive to signals of stress. The system may appear stable again, but it's operating under new constraints. There's a misconception that trust is binary. Either it's there or it isn't. In reality, trust exists on a spectrum. It can thin without disappearing entirely, and that thinning is enough to change outcomes. Liquidity doesn't have to vanish completely to create problems. It just has to become selective, uneven, unreliable. I've watched this dynamic unfold in sovereign contexts as well. When confidence in a currency weakens, people don't abandon it all at once. They hedge, they diversify, they seek alternatives. These actions are rational at the individual level, but collectively they accelerate the very process they're meant to protect against. Trust erodes not because people are irrational, but because they're responding logically to uncertainty. There's a moment in these situations when policymakers realize they're no longer managing economics, they're managing psychology. Interest rates and balance sheets matter, but so does narrative. Credibility becomes as important as capital. And credibility, once questioned, is difficult to restore with technical measures alone. I remember a conversation with a senior official who admitted quietly that their greatest challenge wasn't designing the right policy response. It was convincing people that the response would work. That's a different problem entirely. It requires belief, not just logic, and belief can't be mandated. This is why trust leaving money is such a profound event. It exposes the limits of control. It reveals how much of the system's functionality depends on shared assumptions rather than enforceable guarantees. It shows that money is not just a medium of exchange, but a medium of confidence. Emotionally witnessing this can be disorienting. There's a sense of standing slightly apart from the world as it continues to operate under assumptions you no longer fully share. You go about daily life, but with an awareness that the mechanisms supporting it are more delicate than they appear. That awareness doesn't make you fearful, it makes you attentive. False stability thrives when trust is taken for granted. When people stop asking why money works and focus only on how much of it they can deploy, but when trust begins to thin, those questions return, and they don't have easy answers. I've learned to listen closely during calm periods for subtle changes in tone, not just what is being said, but how it's being said. When certainty gives way to conditional language, when reassurance replaces confidence, these shifts are small, but they matter. They signal that trust is no longer assumed. Understanding this doesn't mean expecting collapse around every corner. It means recognizing that trust is an active ingredient, not a background condition. It must be renewed constantly through consistent behavior, credible institutions, and believable commitments. When any of those weaken money changes character, as this reflection continues, the focus shifts naturally from the mechanics of trust leaving money to the deeper question of why people are so often unprepared for that shift. Why the departure of trust feels like a surprise, even though history is full of examples. That question isn't about finance alone. It's about how humans relate to stability, authority, and belief. And it's there in that intersection that the next layer of understanding begins to emerge. Once you begin to see money as trust rather than value, the structure of the system starts to look different. The familiar language of markets and prices fades into the background, and what comes into focus instead is power. Not power in the dramatic sense, but the quiet ability to influence belief. Who is trusted to issue promises, who is believed when those promises are questioned, and who is left exposed when belief begins to fracture. This is where many discussions about money go astray. They stay at the surface arguing about numbers, ratios, and technical mechanisms while missing the deeper reality that money has always been an expression of authority. Gold once carried that authority because it was scarce, tangible, and outside political control. Fiat currencies carry it today because states enforce their use and because people believe those states will endure. Neither form is purely economic. Both are political in different ways. I've spent years working at the intersection of markets and national security, and one lesson becomes unavoidable the longer you stay there. Financial systems are not neutral. They reflect the priorities and power structures of the societies that build them. Reserve currencies don't dominate because of efficiency alone. They dominate because of trust in institutions, legal systems, military reach, and geopolitical alliances. When those foundations are stable, the currency feels stable. When they're questioned, the currency begins to feel conditional. I remember advising on scenarios where economic outcomes were inseparable from geopolitical ones: sanctions, trade restrictions, capital controls. These tools don't just move markets, they alter perceptions. They remind participants that access to money can be influenced, restricted, or withdrawn. Once that realization sinks in, trust changes. Money becomes less about convenience and more about vulnerability. This is one reason why trust leaves money unevenly. It doesn't vanish everywhere at once. It retreats from the edges first, from jurisdictions perceived as weaker, from institutions perceived as less transparent, from promises perceived as more political than economic. That uneven retreat creates distortions. Capital flows become erratic, volatility increases in unexpected places, and the system which once felt integrated begins to fragment Central banks sit at the center of this dynamic, often misunderstood as purely technical actors. In reality, they are guardians of confidence. Their balance sheets matter, but their credibility matters more. Their words are parsed not just for policy intent, but for conviction. When they speak, markets aren't listening for data, they're listening for reassurance that someone still understands the system well enough to manage it. For long stretches of time, this works. Confidence is restored, markets stabilize. The narrative of control reasserts itself. But each intervention carries a cost that's rarely visible immediately. It reinforces the belief that stability can be engineered indefinitely. That belief encourages risk taking. It compresses margins of safety. It shifts behavior in subtle ways that only become apparent under stress. I've sat in meetings where officials spoke candidly about these trade offs, about how maintaining calm today might increase fragility tomorrow. These weren't reckless people. They were deeply aware of the consequences of inaction, but they were also constrained by the realities of power. Markets expect intervention. Political systems demand continuity. And once expectations are set, stepping back becomes harder than stepping in. This is how trust becomes institutionalized and why its loss is so disruptive. When belief is embedded not just in money, but in the idea that someone will always prevent failure, the system grows dependent on that belief. When it's challenged, the reaction is not gradual adjustment, but shock. There's a line I've returned to often over the years because it captures this fragility so well. Liquidity disappears exactly when you need it most, not because it was never there, but because it was conditional. It depended on confidence that no longer exists. In calm periods, liquidity feels like a feature of the system. In reality, it's a behavior, and behavior can change quickly. This is where the distinction between volatility and risk becomes critical. Volatility is visible, it can be measured. Risk, especially systemic risk, often isn't. It accumulates quietly during periods of calm when everyone is focused on optimizing returns rather than questioning assumptions. By the time volatility appears, the underlying risk has usually been building for years. I've found that the most misleading signal in finance is smoothness. When markets move gently, when correlations behave as expected, when outcomes feel predictable, it creates the impression that the system is healthy. But smoothness can be a sign of suppression rather than strength. Of forces pushing against natural variability, and suppressed variability has a way of returning with force. Understanding this changes how you interpret stability. It stops being something to rely on and becomes something to examine. You begin to ask what is being held together and by whom? What assumptions are being made implicitly? What would happen if those assumptions were challenged not dramatically, but just enough to introduce doubt? There's an emotional shift that comes with this perspective. You stop looking for comfort in consensus. You become less interested in being reassured and more interested in being clear. That clarity can feel isolating at times. It puts you slightly out of step with narratives built around certainty and progress, but it also provides a steadier footing when those narratives begin to wobble. I've learned that power in financial systems doesn't lie in prediction, it lies in optionality, in the ability to respond rather than react, to remain deliberate when others are forced into urgency. That ability is shaped long before trust is questioned. It's shaped during periods when trust feels abundant and unnecessary to think about. When trust leaves money, it exposes these differences starkly. Those who relied on continuous confidence find themselves constrained. Those who respected fragility retain flexibility. The gap between those positions can widen quickly, not because of intelligence or foresight, but because of how risk was approached when nothing seemed wrong. This isn't a comfortable realization, but it's an important one. It reminds you that money is never just about economics. It's about belief, authority, and behavior. And when belief begins to thin, the system reveals its true structure. As this reflection deepens, the focus naturally turns to the human element behind all of this. Why confidence returns so easily after crises? Why caution fades? Why each generation convinces itself that the lessons of the past no longer apply? Because trust doesn't just leave money, it leaves people unprepared when they assume it will always be there. After watching this cycle repeat enough times, you begin to understand that the most fragile part of any financial system is not the balance sheet or the policy framework, it's memory. Not what people know, but what they feel they remember. The emotional weight of crisis fades much faster than the intellectual lesson, and when that happens, confidence quietly returns to places where caution once lived. I've seen this pattern across decades and across countries. Right after a crisis, there is humility. People speak carefully, risk is discussed openly, assumptions are questioned. For a while, restraint feels wise. But over time, as markets stabilize and life resumes its rhythm, that restraint begins to feel unnecessary. The absence of immediate danger is interpreted as proof that the danger has passed rather than as a temporary condition. This is how trust rebuilds itself, not because the system has become fundamentally stronger, but because human psychology demands normalcy. We are not built to live indefinitely in a state of vigilance. We seek closure. We want to believe that what hurt us once has been fixed for good. And when institutions reassure us, when markets reward risk taking, again, that belief feels justified. The problem is that systems don't remember the way people do. They don't learn emotionally. They carry forward the consequences of every decision made during calm periods, even as the memory of why caution mattered fades. Risk doesn't reset when fear does. It accumulates quietly embedded in structures that look efficient until they're tested. I've often thought about how easily confidence returns after near failures. In the aftermath of major crises, there is always a moment when people say, "We came close, but we managed it." That sentence contains both relief and danger. Relief because collapse was avoided. Danger because survival is mistaken for resilience. The system didn't break, therefore it must be strong. That conclusion is comforting, but it's often wrong. What's rarely acknowledged is how much improvisation goes into surviving crises: extraordinary measures, unprecedented coordination, decisions made under pressure that no one would accept under normal conditions. Those measures work in the moment, but they're not proof that the system is stable. They're proof that it was vulnerable enough to require them. As time passes, the extraordinary becomes normalized. Emergency tools remain in place, interventions become expected, markets begin to assume that support will always arrive. This changes behavior in subtle ways. People take on more leverage. They accept thinner margins of safety. They rely on the presence of backstops they've never seen fail. And with each cycle, the system grows more dependent on confidence that has been externally reinforced. This is where trust becomes most dangerous, not when it's absent, but when it's unquestioned. When skepticism is dismissed as negativity, when caution is reframed as a lack of imagination, in those moments, false stability has taken hold. The system feels calm, not because it's healthy, but because everyone is aligned around the same assumptions. I remember conversations where concerns were raised, not rejected outright, but deferred. Not now. Unlikely. We'll have time. Each response made sense on its own. Together, they formed a pattern of delay, and delay is how fragility grows. Risk is acknowledged but postponed, and postponed risks have a way of returning all at once. There is also a social cost to being cautious during calm periods. You underperform, you look conservative, you're told you don't understand the new environment. Over time, that pressure erodes resistance. People don't abandon caution because they've been convinced. They abandon it because the cost of holding it feels too high. False stability doesn't silence dissent, it wears it down. This is why crises always feel surprising even when they aren't. By the time doubt becomes acceptable again, the options have narrowed. Liquidity is thinner, trust is conditional, behavior has already shifted. What feels like a sudden break is often the result of a long period where warning signs were normalized. I've learned to pay close attention to moments when confidence feels effortless, when optimism goes unchallenged, when the idea of systemic failure feels almost impolite to raise. Those are not moments of strength. They're moments of narrative dominance. And narratives, no matter how convincing, are fragile. There's a quiet sadness in recognizing this pattern because it suggests that crises are not accidents in the usual sense. They are the outcome of reasonable decisions made under the assumption that stability will persist. They are collective, not individual. And because they're collective, they're difficult to interrupt. This understanding changes how you relate to calm. You stop seeing it as a destination and start seeing it as a phase, a window, a period when choices are still available and preparation can happen without pressure. Calm becomes informative rather than reassuring. Living with this perspective doesn't mean expecting disaster. It means accepting that stability and fragility coexist, that progress does not eliminate risk, it reshapes it, and that each generation inherits not just the benefits of past decisions, but their unresolved tensions. As we move toward the end of this reflection, the focus shifts naturally from why trust leaves money to how individuals navigate a system where trust is never permanent, because understanding the cycle is only useful if it leads to a different relationship with risk, one that is quieter, more deliberate, and less dependent on the comfort of consensus. By the time we reach this point, the idea of trust leaving money should no longer feel abstract. It should feel human, familiar. not as a dramatic rupture, but as a shift in behavior that happens quietly, almost politely, until it doesn't. That understanding changes how you think about what comes next because it reframes the question entirely. The question isn't how to predict when trust will fade. The question is how to live in a system where trust is always conditional. I've learned that the most important decisions around risk are rarely made during crises. They're made during calm periods when nothing demands action and everything encourages complacency. That's when posture matters more than movement, structure more than speed, and humility more than confidence. When people ask what they should do when trust leaves money, I usually resist giving a checklist, not because there's nothing to say, but because checklists imply certainty. They suggest that the right action at the right time will solve the problem. In systemic events, that's rarely true. What matters more is how exposed you are to assumptions you don't control. Every financial system rests on assumptions that payments will clear, that markets will function, that institutions will perform their roles as expected. Most of the time, these assumptions are reasonable, but systemic risk lives in the space between reasonable and guaranteed. When trust thins, those spaces widen. I found it useful to ask a different kind of question, not what will happen, but what am I relying on without realizing it? Am I assuming liquidity will always be there, that counterparties will always act rationally, that interventions will always arrive in time? These assumptions don't announce themselves, they reveal themselves only when they fail. Preparation in this context is not about bracing for collapse, it's about reducing fragility, about maintaining flexibility, about avoiding structures that require continuous confidence to function. These choices often look unremarkable during good times. Sometimes they even look conservative, but their value emerges when conditions change. There's a tendency to think that preparing for uncertainty requires constant action. In reality, it often requires restraint, the ability to resist narratives that promise permanence, the discipline to accept that not every opportunity needs to be pursued, that not every risk needs to be optimized. In a world where trust can change character quickly, optionality is a form of strength. I've also learned that simplicity matters more than sophistication when trust is under stress. Complex systems perform beautifully when assumptions hold. They break unpredictably when they don't. Simpler structures may seem inefficient during calm periods, but they tend to be more forgiving when behavior shifts. Forgiveness in systems is underrated. Emotionally, this way of thinking can feel isolating. It places you slightly out of sync with environments built on optimism and momentum. You may find yourself less interested in reassurance and more interested in clarity, less focused on consensus and more attentive to structure. That can feel lonely at times, but it's also grounding. There were moments in my career when seeing these risks early felt like a burden, when raising questions about trust during calm periods was met with polite dismissal, when caution was interpreted as pessimism. Over time, I realized that this discomfort was part of the process. Systems don't reward foresight immediately, they reward alignment until they don't. What steadied me was reframing what success meant, not being right about timing, not avoiding every loss, but remaining intact, preserving the ability to choose, retaining composure when others were forced to react. That kind of success doesn't show up in short term metrics, but it matters when metrics stop functioning. There's also a quieter lesson embedded in all this. Trust leaving money doesn't just test systems, it tests people. It reveals how we respond when familiar structures feel uncertain. Some react by seeking certainty at any cost, others by withdrawing entirely. The most resilient responses tend to be the least dramatic. They're deliberate, measured, patient. I don't believe that fear is a useful guide in these moments. Fear narrows vision and accelerates mistakes. What's more helpful is respect, respect for history, for complexity, for the limits of control, and for the simple fact that systems built by humans will always reflect human behavior. When you respect that reality, you stop looking for guarantees and start building margins. You stop chasing predictions and start cultivating resilience. You stop asking how to beat the system and start asking how to endure it. This doesn't require constant vigilance or emotional strain. In fact, it often brings a sense of calm, not the calm of denial, but the calm that comes from alignment, from knowing that your posture doesn't depend on everything going right, that you're not relying on trust being permanent to feel secure. There are moments when the most appropriate action is no action at all, when observing quietly provides more information than reacting quickly, when allowing uncertainty to exist creates space for better decisions. That kind of patience is difficult in a culture conditioned to respond instantly, but it's invaluable when trust is the variable that's changing. As you move forward, remember that stability is not a promise, It's a condition, a shared belief that holds until it doesn't. Trust is powerful, but it's not immutable. It must be earned continuously, and it can thin without warning. You don't need to live in fear of that truth. You don't need to predict when trust will leave money. What matters is recognizing that it can and that systems behave differently when it does. That recognition alone changes how you engage with the world. If you want to keep thinking with me, the next chapter is waiting. The greatest risk is believing there is no risk.